IRB Infrastructure Developers Limited is one of India's leading players in infrastructure development and construction, with a strong focus on roads and highways. The company develops, operates, and maintains projects across the country, using models like Build Operate Transfer, or BOT, and the hybrid annuity model, known as HUM. IRB's portfolio includes a solid mix of operational toll roads, annuity-based projects, and several key projects still under construction. With a strong presence in major states, IRB continues to expand its footprint through smart acquisitions and aggressive project bidding. Revenue. Let's start with revenue. Over the past 5 to 10 years, IRB infrastructure has shown a mix of steady and cyclical growth. While toll collections form the bulk of recurring income, the revenue stream also includes annuity payments from HUM projects and construction income from ongoing infrastructure work. Look closely, and you'll notice certain seasonal trends, often influenced by monsoon disruptions, election cycles, and the pace of government infrastructure spending. Strategic wins in BOT and HUM projects have been key drivers for revenue spikes during specific fiscal years. Now, moving to profitability. We assess this through three key lenses: gross profit margin, operating margin or EBITDA, and net profit margin. IRB has maintained an EBITDA margin of around 45 to 50% in recent years, which is strong for a capital-heavy business. Net profit margins, however, are more volatile, mainly due to interest costs and high depreciation charges from completed projects. Compared to industry averages, IRB stands tall on operating efficiency, but the bottom line has occasionally dipped, depending on debt servicing and one-time items. Let's talk about leverage. Infrastructure is a debt-intensive game, and IRB's debt-to-equity ratio has historically been on the higher side, crossing 1.38 times. But recent capital infusions and asset monetization have helped bring it down to below 1.0, a positive shift. The debt-to-EBITDA ratio has also improved, falling from over 3.5x to around 2x. Meanwhile, the interest coverage ratio has strengthened, indicating improved ability to service debt without straining profit. Cash is king, especially in infrastructure. IRB's cash flow from operations has remained mostly positive, backed by steady toll collections and annuity inflows. However, cash used in investing activities has been substantial, reflecting ongoing capital expenditure in new projects. On the financing side, there's a regular churn of inflows from debt and equity, and outflows for repayments and interest. The key number to track? Free cash flow, or FCF, and IRB has made progress in stabilizing it, especially after 2022. Return on equity, or ROE, reflects how well the company generates profits on shareholders' capital, while return on assets, or ROA, indicates how efficiently total assets are being used. IRB's ROE has ranged between 8 to 12%, while ROA is typically lower, around 3 to 5%, which is common for infrastructure companies, due to high asset bases and depreciation. Compared to peers, IRB is in a stable position, but the returns are modest, highlighting the long gestation nature of the infra sector.